Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. Treasury yields are hitting new highs. A new Fed chair is in play. A double dose of surprisingly higher inflation readings, and oil futures are sticking firmly for now above the $100 a barrel level with the ongoing conflict in Iran. So as a wall of worry builds, are ETF investors adequately prepared? Joining me now is John Davi, CIO at Astoria Portfolio Advisors, and Joanne Bianco, Senior Investment Strategist over at Bond Blocks. Thank you both very much for being here with us right now. Let's set the stage about the rate side of things and how it affects strategy. And Joanne, I'm going to start with you first on this one. How exactly are you viewing the current inflationary threat? And is it something that you feel has legs, medium to longer term, and that needs to be repositioned for?
Yes, it's something that definitely could have legs to the extent that we continue to see this ongoing conflict with the U.S. and Iran, and the Strait of Hormuz continuing to be closed, and the potential for continued energy disruption or energy supply disruption. So those things are all inflationary, and it really just does change the picture from what we saw at the beginning of the year in terms of what we saw the outlook would be for rates.
And Joanne, what exactly are you seeing in the marketplace right now that would suggest to you that we could have this kind of medium to longer term impact of the current inflationary environment?
I think part of it is probably just that we're not seeing a resolution. We're seeing ongoing negotiations between the U.S. and China and Iran, but we're not actually seeing resolution. So that is something that, you know, kind of like the longer this goes on, the longer that we see supply disruption in energy, the worse this is for the reacceleration in inflation. And then eventually there's going to be an economic impact of this we don't know what we're going to see in terms of the upcoming driving season for consumers with the summer, and the sticker shock of higher gas prices and what that does to economic activity.
All right, John, all of this is translated into an interesting market narrative that's developed from when before the war started to where we are right now. Before the war started, there seemed to be at least a little bit of traction for this kind of so-called broadening out trade, the value cyclical trade that was not so hyper-focused on hyperscalers and mega-cap technology stocks. Yet since the market lows that we saw around kind of the end of March, it has been off to the races with regard to what has worked pretty much since the great financial crisis, and that is a return to mega-cap tech. Is that something that you see continuing? Have we now reversed course and gone back to the old paradigm of just buy everything mega-cap tech?
Well, we're coming off a very strong U.S. earnings season. A lot of the hyperscalers, printed very strong results. So I think, though, on the margin, so look, we own the hyperscalers. We think that they're big, they've got moats, they produce good cash flow. You can't ignore them, let's say. But incrementally on the margin, we are adding to more real assets, and we are, sort of adding to like more equally weighted strategies. And I think, if you just look at Joanne talked about the Strait of Hormuz, the oil conflict. But if you look at 10-year JGBs, there are 20 basis points in the last week. That's a 3 sigma move. The U.S. 10-year just crossed past 4.5 to 4.6. Historically, when stocks, sort of cross 4.5, they've wobbled in the last few years. And, there is like negative 80% correlation between the U.S. 10-year and moves in the S&P. So, when we build portfolios for advisors as an OCIO, we want to sort of balance out the risk of owning those hyperscalers with real assets. And, we manage a fund PPI, which, we launched it in 2021. Our firm had a view that inflation was going to be structurally higher and higher for longer. And, since 2021, we've outperformed the S&P 500 by 25%. And that's without leverage or convexity trades. So it tells me that there is, a dominant theme that real assets are performing well. And then when I look at like all the different asset classes and what's worked well, or what's the leader in the last 7 years, I see that real assets have led the market. They've been the highest performer in 6 out of the 7. So I would look past the Strait of Hormuz and just sort of build a portfolio that can provide inflation protection, because I don't think we're going to get down to 2% anytime soon.
All right. So can I follow up that with you, John? real assets are a catch-all for all different kinds of things, right? All different types of assets kind of fit the bill. Where exactly are you seeing kind of the best opportunities around that real asset story? You mentioned that you manage a fund along those lines, but I mean, are we looking in the precious metal side more than we are looking in, say, the oil and gas side? Are we looking on the real estate side of things versus some certain other, and within real estate, is it more commercial or residential? How exactly does that real asset diversification start to work in your mind? Where are the best opportunities?
So good question. And, admittedly, I would say, when I said 6 out of the last 7 years, real assets have led, a lot of that has been gold and then, the broad commodity indices. But I think there's going to be a rotation where you'll start to see, the broaden out to other metals besides gold. I mean, we tend to really like, the data centers, power plays. So that's in like the utilities bucket or the REITs bucket. So if you really are, believe that AI is going to transform, I would sort of say, look at the second derivative effect of that. So you can just own the hyperscalers or own the beneficiaries of that. And that's what our fund does. It gives you broad-based exposure to energy equities, utility equities, industrial equities, REITs. And we do have some gold just because that sort of helps manage our volatility.
And Joanne, if I could turn back to you for a moment here. Given what we just heard from John with regard to how that real asset story is playing out for his portfolios and his clients, what exactly from a strategist standpoint do you see in the market right now that could suggest maybe that kind of a trade has legs outside of the fact that we are maybe in this kind of higher sticky inflationary environment? Is there a reason why you would want to maybe divert more of your resources towards a real asset trade, or are you more comfortable with other parts of the market right now?
Yeah, that's definitely a very good question. But we're really focused on the areas that we see the benefit of the resilience in the U.S. economy, kind of like working in the favor of different fixed income asset classes. So what we like the best in terms of what we're recommending to our investors. It starts with our short duration emerging markets fund. That's been, kind of a good area in terms of getting better carry, better yield, better total return potential. It was our best performing fund last year. It's our best performing fund year to date, and that ticker is XEMD. We also really like other shorter duration sectors. So we still are very constructive on the high yield market. We have the high yield market is benefiting from strong fundamentals, resilient economy, a very good earnings season that we're just coming off of. Earnings have been impressive. Forward guidance is still stable to strong. So we still like high yield, and there it's a combination of different funds that we have. We have a sector rotation fund, HYSA. We also have a double B rated fund, XBB, and a single B rated fund, XB. So those are kind of our top picks there.
All right.
And then finally, I guess one other area that we really like is we have a private credit CLO fund, PCMM. And that one, the floating rate nature of that, the income that it keeps providing for investors versus its average quality in the single A range, and it's throwing off income in the 7% range. That's had very low volatility in all of these different market environments, and so that's another one of our top picks.
All right. So what's interesting here is that both of you have alluded to kind of this notion that there is some kind of underlying, at least, strength for certain key parts of the market overall, and maybe the economy by or not worth, for extensions purposes. Those are things that I think are being told in different ways through different asset classes. I wonder, John, I'll go to you for this one. Are you seeing any signs that there could be a potential risk event to the markets for valuations or for anything else? You mentioned the strong earnings season that we've seen. But this is also a market that has come really far, really fast since the war lows. Is there any fear that there could be some kind of a precipitous risk-off scenario given what we know so far?
I would watch the 10-year. I really think that's sort of like there's a line in the sand. Once you cross, 4.5%, historically stocks have wobbled. But that's like on a very short-term basis. I mean, the strength of the U.S. economy, Joanne has alluded to this. I mean, for sure, that is the reason why rate cuts have been priced down and out and why we have rate hikes on the table. A new Fed chairman, always, kind of like signals some short-term volatility. I think we have to get used to kind of what he's thinking about the balance sheet reduction. But, for how we build portfolios, we're sort of long-term in nature, and the strength of the U.S. economy, I think, is going to continue. So we like to lean in on that. But, as I said, we like the hyperscalers, right? Like we think you should own them, but incrementally on the margin start to like, tilt towards other sectors and themes and asset classes, because if the economy is strong, as we're all agreeing on, lean where you have a margin of safety. So that's some of these other themes that like Joanne has talked about, like EM debt. I mean, our firm, we also like emerging markets, quite a bit. So, we're global in nature, and that has actually helped portfolio construction. It hasn't hurt. So, if you have a tailwind of, strong U.S. economy, why do you just want to kind of go all in on like SPYs and Qs is kind of the point. Start to diversify away.
Now, curious as well, Joanne, from your point of view, one of the big stories that we saw kind of play out over the course of the, I guess, the market story since the war began is this notion that even when we saw weakness in the equity markets overall, we did see some corresponding weakness to pretty much all other risk asset classes, including high yield that you mentioned before. But was it surprising to you that the high yield fixed income market held up relatively better and markedly so versus the equity markets, which a lot of people say that they tend to kind of trade more like sometimes? Has the high yield story maybe shifted a little bit so that there is always going to be this underlying demand for high yield debt no matter what kind of market environment we're in?
I think it has to do with the fact that we have the kind of the highest credit quality high yield market that we've had in its history. Over 56% of the market is rated BB. We've had really strong to stable like leverage statistics and balance sheet metrics. Is really since the pandemic, companies have focused, management teams have focused on refinancing their debt as opposed to anything that is leveraging or more speculative. So we have a better quality high yield market. I'm not surprised that it didn't widen that much in spread with the equity market volatility. We're in an environment right now where we do have like really sound fundamentals for the high yield asset class, and it shows.
Okay. Now, John, with regard to, you mentioned kind of like the core side of things in your portfolios, and then at the edges, kind of adding some places that you can find alpha, some outperformance there. I wonder from your perspective, just how long this current market story can last. I had mentioned during the on-air segment that we had at Halftime Report that there is this kind of idea that maybe we could see a shifting of portfolio strategies given this kind of more bigger inflationary threat these days. At what point would you then say it's about time to change the way that we approach portfolios yet again? How much of a catalyst needs to happen for you to say, hey, maybe we should think about things differently?
The short-term catalyst I would look for is, watch Kevin Warsh and what he's saying, in terms of like balance sheet reduction, watch the 10-year. If you tend to be more longer-term in nature, I would argue that, SPYs and Qs, which dominate most portfolios, incrementally, I mean, it got very cheap in the sell-off, when we had the Middle East sell-off. And I think we bounced pretty hard off the lows because, I mean, these companies have huge moats, admittedly. What I would just say is that, when commodities trend, and they're trending now because of higher inflation, the Middle East conflict. I mean, I've seen periods in my career where commodities will, lead for 10 years or so. So we're sort of like 5 years into this like inflation cycle. And, I do think that in the next, 2-3 years, they can continue to trend. Also, I'm not making a call on small cap because small cap's been like a very difficult asset class to own. But, if you just look at like sort of equal weight strategies, we run an equal weight fund ROE, which actually has outperformed the S&P 500 by 600 basis points. year to date, and we beat on a 1, 3, 6 month and 1 year basis. So the point, Dom, is like, there are other things that are working besides just SPY. And so now you have to kind of do your due diligence and pick and choose, and you have to come up with your rationale for it. So we like the barbell approach. On the equity side, we have a fair amount of the hyperscalers, but we are adding towards like, tickers like PPI, broad-based commodities. We use another broad-based commodity ETF called CERY. We have equal weight strategies because we think they're beneficial. We own emerging markets. We're big fans of the IEMG. Within fixed income, we're very, sort of like spread out. Like we have like very specific bets. We like a lot of the stuff Joanne's talking about too. We like high yield credit, but we're sort of balancing out our fixed income exposures with like a 3 duration. So I think that's the idea, is like is broaden out your portfolio construction.
All right. My thanks to both John and Joanne here for the conversation. John Davi, Joanne Bianco. We've asked Joanne to stick around for the ETF Edge podcast. You can catch that and all of our other content over at etfedge.cnbc.com. Thanks for watching, and we'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.